Welcome back. You're watching Stock Picks. Today we look into AVI famous Brands and Spur with Cobus Potgieter from Southern Cross Capital. Bringing us an analysis of those counters. Thank you so much for your time, Cobus. These are pretty fitting to have a conversation on these counters during lunchtime. So let's cut our teeth into it, starting off with Famous Brands. Famous Brands is a very, very interesting one. There have been lots of developments in terms of the geographical diversification, where they didn't do so well in the UK, but also here back at home, really not having a good time, particularly in the last maybe year with load shedding costs and all of those. What do you make of Famous Brands, just its composition, but also just investor sentiment around it?
So Famous Brands are a nice basket of brands, absolutely. If you're one of those sort of brand-focused investors, it's in the name of the company, and call it the Warren Buffett style, investing into brand as opposed to investing into business. Characterized by a few investment missteps. Again, an offshore adventure in the form of the Great Burger Company, which didn't work out for them in the UK, as it did for so many South African restaurants and other businesses, frankly, Nando's notwithstanding. Locally as well, a couple of missteps. We had a set of results that was very much focused on load shedding. And then with that, the update for the first 2 months, which looked subdued despite load shedding alleviating somewhat. We will be getting an update in the form of the AGM towards the end of this month. I believe it's the 26th of July, which will add another 2 months in terms of update data, which won't include load shedding. So I think, the market broadly expects to see an update there, see whether or not that has ticked up or not. But honestly, that last set of results very, very, flat, down 5%, excluding the liquidation from that UK adventure, sort of flattish to up 2%, right? Because that happened in the previous period. So there was a small little stip in dividend from that liquidation in the comparable period of 75 million. Generally, the sentiment around the stock has picked up a lot in line with SA Inc. So these stocks are exciting to look at the moment. But in terms of actual execution, this one perhaps historically has had, poorer management than its peers.
Cobus, do you think we talk about this adventure in the UK that didn't quite work out? Do you think that there could still be an overhang of that, just looking at how investors have seen the company after that?
Yes. There's certainly an overhang in the form of cash availability and indebtedness, right? So it's still quite geared. They've had to cut the dividend by, I believe, more than the shrinkage in earnings. And on top of all that, it's happened at a bad time when the local businesses under pressure, discretionary spend is under pressure. Specifically in quick service, we've seen a bit of pressure. We'll chat about that when we get to the next name. And so they've had to chip in on the franchise fees, which is a major source of revenue for them, to try and support their franchisees at the same time of having a little bit of balance sheet distress. Having said that, I think quick service is so under pressure. Perhaps now is the time to go sniffing for value. It's hard to tell. But again, Famous Brands does have that execution risk tied to it. And typically, it's simply, give some major strategic decisions. It's not just a Great Burger Company. Others before that, the likes of Tasha's and others, have been poor and poorly executed. So, it's a tough one, but certainly a value proposition. I think it's at about a 9.5 forward on consensus earnings. So that's quite cheap for an SA Inc. stock that hasn't quite seen the same level of, upwards drift post the positive election outcome.
I mean, going back to your point, saying that in the last reporting period, it was really a load shedding story. There was a lot of pressure due to load shedding over there. And obviously now when they come out with the 2-month update after that, there'll be no load shedding. So maybe a little bit of alleviation there. But I mean, would you say that as much as there's, obviously was this huge load shedding cost, that there are still just other things that they need to address that could limit momentum going forward?
Yes, yes. Look, I don't want to segue into our next pick,
Yeah.
just like that, but
Yeah.
frankly, the peer in Spur has outperformed.
Yeah.
So, I mean, to be more specific, Spur has more casual dining exposure. So we distinguish between
Quick
quick
service.
service
Okay.
and casual dining. And what's really fun, and I mean, is that as part of the retail sales numbers, Stats SA actually track inflation for both quick service and casual dining. And that over time, the trend has been for quick service to inflate significantly ahead of casual dining. And I mean, we can all sort of anecdotally relate to this. When Uber Eats burst onto the scene and Mr. D followed, a quick service, ordering something from a Mama's or any takeaway restaurant,
Yes.
that was a great deal. And there was sort of an element, part of the value proposition was you're not sitting in my restaurant occupying my capital, right? So you're eating at
Yes.
home. Your home is the restaurant. Ergo, there should be a reasonably cheap experience with a small
Yes.
premium for delivery or convenience. Over time, increasing oil prices, increasing fuel prices, that has had to be, sort of subsidized from somewhere. And we believe that has been captured by the likes of Mr. D and Uber Eats in the form of, taking more margin from the
Yeah.
restaurants, which means they have to put up those prices, which means that quick service ends up becoming more expensive than casual dining. And the perception has been that casual dining value has remained pretty good. The inflation there hasn't been so aggressive over the last 2 years,
Yeah.
whereas quick service, it's become you're paying a massive premium for that convenience now. And we've seen that play out in the actual numbers as well. So Spur, which is significantly more casual dining exposure, are massively outperforming. And over a more or less comparable period, Spur managed to increase headline earnings by 15%. And in fact, have since subsequent to that, have in fact outperformed even more in the wake of the SA Inc. rally post the May election.
Cobus, you've just made me smarter because I feel like I've seen this. I've seen, the fact that these quick service restaurants are so expensive. And you think if you're going to spend that much money on food, you'd actually rather just go sit down then, so that at least you get the full experience. I just had not been able to explain it or to express it in economic terms. But
That's what Stats SA is for.
Yeah, absolutely love that. Spur, you talk about, it's quite interesting the points that you make also that quick service, has inflated ahead of the casual dining. So let's talk about Spur and that outperformance.
Okay, so Spur, it's not a well-covered stock. It's sort of a well-loved stock that is zero analyst coverage or credible analyst coverage in any case.
Yeah.
The last set of results for the full year to the half year to 31 December, they increased HEPS by 15% on a fully diluted basis. The next update we're going to get is around August, which will be a trading update just ahead of releasing the full year results for June. So again, that'll contain 4 months of essentially zero load shedding, which will be interesting. And the market fully expects them to continue that outperformance. The core Spur steak ranches business has performed remarkably well and been particularly resilient, given that it sits a bit lower in the LSM chain relative to Mama's, which is or SARS, which is also owned by Spur. And they've been known to be particularly good to their franchise owners. The franchise owners love Spur head office, and during the tough times, they've sort of dropped the specials or added additional subsidization or dropped the franchise fees. And despite that, have shown decent gross margins and decent growth over the period. And if you're taking the view that South Africa has bottomed out and we turning more positive and we turning, in the long term, there will be more economic growth. I guess 10.5 forward PE on a business like Spur, which also yields well, is reasonably attractive.
Does Spur, in terms of its composition, do you think that they really have shown that they think ahead? For example, in terms of now adding Doppio Zero, I was talking to you off air about the revamping that they did in Melrose Arch, where they had a pizza vino and they turned that into Sicchio to kind of appeal to that LSM. Do you think that that's just, part of their character, that they do think ahead, and also just cater to all sorts of consumers and consumer incomes?
But I'm not sure how they are handling the Doppio acquisition, whether or not that's going to be a franchise or an equity model.
Okay.
I mean, curiously, some of the other higher end businesses which they have been launching, RocoMamas, Hussars, those have been equity owned, so not non-franchise businesses.
Okay.
They've managed the growth there reasonably, and those businesses have sort of come from nothing, greenfields type level investment, and they've done particularly well. So that's almost a step change away from the old Spur Steak Ranch and Panarottis and John Dory franchise model, which is their core. And I mean, honestly, like John Dory hasn't been performing well, and nor has Panarottis really. It's a bit of a mix, sort of a departure from the traditional model, but it's a departure they've taken for a long time now.
Okay.
And that has generally been pretty well pursued, so and pretty well executed. So no, I mean it's a good management team. It's conservatively managed. It's never geared or excessively geared, and it's proven to be resilient and sort of well loved, the brands amongst the South African consumers. So I really like the stock, and if you are pro SA growth, it's a really nice one to have with, I believe, less execution risk than something like a Famous Brands.
We'll talk about good management. AVI is also another one that is largely celebrated due to good management. How are you looking at that one?
So we've just had a trading update and statement from them, which shut the lights out relative to expectations. I mean, I almost feel sorry for Citibank. They literally downgraded the business to a hold that morning, the morning that the trading statement came out. 7 hours later, this trading statement comes out and sort of justifies it. And that's because the analyst had called it a very strong buy, a very convicted buy, and it had rallied enormously. And now the analyst said, listen, it's hit my target prices. I'm downgrading to a hold. And then they come with this number. So market was expecting around 17% growth. They delivered between 21 and 25% growth. Very, very good. This is H2, so we already had a half-year number to really, sort of gauge where we would end up for the full year. So that's a significant beat. As you've mentioned, excellent management team. Famously, about a year and a half ago, the management team, were so bearish South Africa, essentially like advertising that we are optimizing the portfolio. We are not necessarily reinvesting aggressively, trying to grow. We're just going to sweat these assets as well as we can, because we just don't see that growth. And despite that, the business has performed remarkably well. Maybe because of that, the business has performed remarkably well. H2, we believe, it looks like we saw a major uptick in I&J. So both the catch and perhaps the prices they got for fish. And then the beverages business did remarkably well. We can see it in the revenue numbers. There was an enormous uptick in H2. Some of that is clearly, I mean, they alluded to, they had some of the competitors had supply issues, and we know there was the Cremora production from Nestle. Cremora is an incredibly strong brand, and now AVI's brand, which is so obscure I don't even know it, in coffee creamer, I should be better prepared than this, ended up being the only plausible alternative. It's a little bit cheaper, and perhaps that's allowed them to capture a bit of market share. during that outage that Nestlé suffered. So generally, excellent execution, cost control, very good cost increases just ahead of inflation. And when you're seeing revenues increase well ahead of inflation by about 6.3%, you're going to see nice margin expansion and rating, gross profit expansion. Headline earnings expansion as well.
It's quite interesting also that they've been able to pass on these costs, because obviously the biggest thing for food producers has been the high input costs, and there were concerns, at the beginning of the economic cycle that consumers wouldn't be able to handle those. So that's pretty good and pretty encouraging. Cobus?
Yes, but I must point out
Yes?
the baking business or the snacks business
Yes.
came off a barnstormer run, which did tail off a little bit in this update, which I think the market generally expected. But exactly that phenomena you mentioned has been sort of flattening out, and we expected that benefit to come through. The input costs should have been putting less pressure on them in the current period, and that didn't come through in Tiger Brands numbers, but it certainly did in AVI's. So again, I think just better cost control management, not being caught out, at the wrong point in the cycle, having to fix your business, having to spend money to fix issues precisely when money is tight. So on that basis, I think it's just this more robust balance sheet and better management team have executed remarkably well.
Cobus, just as we wrap up the conversation, the composition of AVI, because for a long time there have been talks that why are they still in fish and why are they still in footwear? How are you looking at this? Are you looking at they really should be trying to get rid of these other divisions that really don't speak to the rest of the business? Or do you look at it from they're well diversified?
And Green Cross was doing well. Nobody, complained. Yes, it doesn't quite fit in as well. They haven't, called anything non-core or something like that. And the fish business in particular is unattractive. It's highly politicized. The quotas, these big private companies or public companies simply don't get the quotas that they should be. They're having to buy quotas elsewhere. So it's not an attractive business, and ultimately it has been diminishing as a percentage of the whole purely through poor performance, frankly. So no, I'm not particularly fond of that. I wouldn't say the execution has been too bad.
But they're sticking to their guns.
But they're sticking to their guns still. Just given the performance overall, I don't think it's been hard to fault them. But you're right. I think there's some capacity for right sizing. But at the moment, getting this business at a 12.5 forward overall, with the prospects of a fat potential dividend going forward, makes it an attractive buy. And my favorites of the three.
All right. Well, thank you so much for your time and for your insights today, Cobus. Much appreciated. That was Southern Cross Capital's Cobus Potgieter.